Hello, I'm Anastasia Amoroso coming to you from iCapital Connect 2025 in Arizona, and this is Beyond 60/40. Joining me today is David Breach, President and COO of Vista Equity Partners, and he shares his firm's differentiating strategy to investing in mission-critical enterprise software. Then, in our Tech Spotlight series, Molly Weiss, Group President of Wealth Platforms at Envestnet, explains how product innovations are expanding access to alternative investments. And as always, I share the one thing that caught my attention this week in private markets. In today's Private Market Pulse Snapshot, the one thing I'm focused on is enterprise software, which is a sector that is at a critical inflection point amidst the ongoing macro uncertainty. Over the past couple of years, markets have faced a number of headwinds, including elevated interest rates and also lack of exits, and all of that collectively led to a reset lower in valuations and slower deal activity. And the enterprise software space has not been immune. In fact, private equity and venture capital deal value in this space dropped another 11% in 2024, following a 29% decline in 2023. Meanwhile, the broader private equity and venture deal value actually rose 10% last year after a 25% decline in 2023, which begs the question, why hasn't enterprise software bounced back as strongly or as quickly? Well, first to blame can be the depressed spending intentions. Enterprise software investment is closely tied to corporate IT budgets. And after the post-COVID tech boom, companies tightened their software spend and focused on cost efficiency. Indeed, looking at this chart, software spending spiked in 2021 before leveling off in 2022 and 23. However, there is a notable takeaway here, and that is companies are still increasing their overall software spend, just more selectively. Now, Gartner forecasts software spend will increase 14.2% year over year in 2025, which, by the way, is an increase from the growth rate seen in 2024. And now that should make up nearly a quarter, or 23%, of the overall $5.6 trillion in global IT spend. So while companies may be more cautious, the sector is still seeing growth. Now, second, another challenge for software has been this prolonged valuation reset. Software multiples have started to recover, but they remain well below their highs. For example, public software multiples are hovering around 5 or 6 times sales, which is well off the peak of 20 times seen in 2020, and even below the pre-COVID norm of 9 times. Now, in private markets, in software, the story is similar. Software M&A exit multiples have edged up from 3.8 times to 4.1 times in 2024, but they still remain well off the 6.4 times peak we saw in 2021. And in venture, valuations have improved somewhat, but step-ups have nearly halved from 2.4 times in 2021 to 1.5 times in 2023. But there is some good news. Earnings growth is starting to accelerate again, and historically that has been a leading indicator for valuation expansion. Now, looking at the prior expansionary cycles, and think 2012, 2017, 2019, multiples have expanded by 51% on average. Plus, this time around, margins are also in a much better spot because they rose from 10% in 2019 to 21% in 24. So with this interesting mix of growth and profitability, we're seeing a setup that could finally help lift valuations. Now, where does this leave us? Well, despite the challenges, things appear to have bottomed out and are improving. And as 2025 unfolds, there is a powerful catalyst that could further fuel a recovery, which is artificial intelligence. For much of last year, AI and Gen AI investors were largely focused on hyperscalers, infrastructure, and the hardware semiconductor layers. But with rapid advancements, especially around DeepSeek, we believe we're now entering the next phase, which is the build-out and integration of AI into enterprise software, and we're already starting to see that unfold. Take Vista Equity Partners, for example. Today, over 80% of their portfolio companies have deployed Gen AI tools. We're also already seeing this AI influence in deal activity too. Google, for example, recently announced a $32 billion acquisition of AI-powered cybersecurity firm Weiss, which is its largest deal ever. And in venture, despite broader enterprise software deal activity being sluggish in 2024, the fourth quarter saw 2 of the largest mega deals in history, OpenAI raising $6.6 billion and xAI raising $6 billion. All of these deals reinforce AI's growing role in enterprise software, and we expect AI to continue to be a significant tailwind in the software space. The bottom line for investors is that enterprise software is at a turning point, and a further rebound will likely depend on three key factors. First, sustained corporate spending, second, earnings acceleration, and third, broader AI adoption. If these tailwinds continue to build, enterprise software will be well positioned for a meaningful recovery. And for investors and GPs, this could mean renewed opportunities in the space. And that's your one thing in private markets this week. I'm pleased to welcome my first guest today, David Breach, who is President and Chief Operating Officer at Vista Equity Partners. Thanks for being here at Connect and here in Arizona. And I know you had a wonderful discussion with our CEO earlier, but I would love to hear more about Vista Equity Partners. I know it's your 25th year anniversary. You've been there for quite a while as well. So tell us about the mission of the company, the focus, what differentiates you.
So Vista was founded by Robert Smith 25 years ago. His focus was really enterprise software, business-to-business software. He saw the business model and thought it was a fantastic type of business to invest in. And his belief was that if you brought a systematic approach to operational transformation, that you could create value for your investors on a very consistent and repeatable and predictable basis. And as you look at Vista today, now being a $100 billion plus asset manager, we currently own 90 companies, about 125,000 global employees across our portfolio, but we remain very keenly focused on the opportunities in the enterprise software space.
So specifically focused on that industry vertical, and I guess the question is why? You know, if I'm an investor and I can have all kinds of diversification in my portfolio, you know, why is focusing on that software niche really beneficial?
Yeah, so what's interesting, so software is the largest part of the global economy, and it's continuing to grow at a 17 to 18% annual compounded annual growth rate. So it's a very large industry that is continuing to get larger. The other thing that's very interesting when you talk about diversification is that when you invest in software, you end up in a highly diversified portfolio. So our companies serve almost every element of the global economy. So there's a natural form of diversification. And the typical company that we want to buy is a company that, you know, in general has 90+% of its revenue is recurring revenue. It tends to have retention rates above 100%. So these are highly resilient businesses. And these are businesses that tend to operate at very high gross margins. We talk about a rule of 40 where we look at the top line growth rate of the company and then its underlying profitability, and those should at least equal 40 when you add them up. So if you're a 10% growth oriented business, you should probably be making 30-35% EBITDA margins on the business. So these are businesses that when run well generate lots of free cash flow and are highly resilient businesses.
Right. And what's interesting about that, David, is with the rule of 40 that you bring up, when you look at the public market software universe, there's actually surprisingly not that many companies that meet that rule of 40. And when I look at the earnings growth for that publicly traded software space, it seems like it really peaked during COVID. It really tapered off, and maybe we're at an inflection point. But I guess my question is, why now? Does software make sense not only from this long-term secular perspective, but is there also an attractive entry point into it now?
It became apparent pretty quickly that software was going to help companies adapt to this new world, and they needed to be closer to their customers from a digital perspective. They needed to digitize their supply chains. They needed to have different levels of connectivity with their employee base. So you saw this pull forward of some software consumption during COVID, and the markets really got very focused on growth, and you saw enterprise software multiples peak at a little over 17 times forward revenue, which for us that have been doing this for a long time, we just thought were crazy multiples. Yeah. Well, you got to 22 and you saw a complete reset, right? People were like, growth at all cost is gone. We talk about 2022 as almost a tech wreck. And you saw all these growth-oriented companies that had started to slow their growth get crushed in the public markets. And so in kind of 22, 23, we saw a lot of opportunity in the public markets to buy great companies and take them private and really make operational transformation in a private context, which is oftentimes easier to do. As you look at where we are in 25, you've really seen the private markets reset their valuations to what we would consider more normalized, 6 to 8 times, 6 to 9 times revenue multiples. The other interesting thing about software is 96% of the companies are private. So if you want to invest broadly in software, it's really hard to do it only in the public markets. So we think there's fantastic opportunity in the private markets right now. We're very excited about it.
We also should talk about generative AI.
Yeah.
And I know you think of it as a huge commercial opportunity, but you think of it in terms of 3 waves. What are they? Which one are we in now?
So as we think about the overall adoption of generative AI, wave 1 is about the semiconductor waves, building out some of the fundamental chip technology to enable generative AI. We really view wave 2 as being the build out of the infrastructure. So whether it's the data centers, the capacity, the compute capacity within the hyperscalers. But we really think the third wave is really the most exciting and the longest tail, which is taking this technology to either enhance the products that you have or build new products and new vertical applications to utilize this technology for customers. And so we are very focused on how our companies can leverage generative AI, and we really see it in kind of 3 different vectors. One is making an enterprise software company operate more efficiently. So we have companies that have maintained fairly large customer support functions that are finding through generative AI solutions that they can deflect 30, 40, 50% of these customer support calls to a generative AI agent. And we're saving the cost of needing those people to provide this support, but the actual customer satisfaction scores are going up. So that's kind of one element of the Gen AI story for software. But then I think the 2 even more important elements on Gen AI are, 1, how are we enhancing our products to make them more valuable, more insightful, to create solutions that expand the TAM for our business. And then as you move into the agentification of our software solutions, we think that expands massively the TAM of a number of our companies and creates, frankly, new pricing dynamics.
Right. I mean, when you think about artificial intelligence, it's a huge shortcut to productivity. And when you think about, you mentioned TAM and the total addressable market of AI, 80% of it is software.
Yeah.
So an incredible opportunity indeed. And you obviously focus on equity investments in software companies, but you also have a very interesting private credit business, Founder Direct. So what is that? Give us a bit of a flavor for what kind of lending you do there.
The concise version of that is we've been able to leverage the Vista ecosystem. So we have over 220 investors that spend all day, every day meeting with oftentimes founders of great software businesses, seeing if they're open to being acquired. Many of these companies are not ready to be acquired, but they have capital needs. And so we can then, frankly, refer them to our credit business to provide a capital solution that is less dilutive than growth equity and provides the differentiation of someone who does nothing but lend into enterprise software businesses. So we call this Founder Direct because we're lending directly into, most cases, these founder-run businesses. And what differentiates us versus others in the private credit space is most private credit is really serving financial sponsors like us in terms of LBO financing. And there tends to be a fairly high correlation between the different private lenders. When we do a large transaction, the 5 or 6 or 7 largest private lenders, private credit providers are all in the same credit with us. This is a highly diversified and differentiated source, and because we have this capacity by bringing all these investors throughout the software ecosystem, we're able to source credit in a very differentiated way, where we get better covenants. We're oftentimes getting warrant coverage. So, we would never give warrants to a private lender in a normal LBO financing, but in these founder transactions, because of the value we're going to bring to them, we're oftentimes getting warrants in these transactions. So we think we're able to create some additional alpha without taking on any increased risk.
Thank you so much, David, for the conversation today. It's been really terrific to hear about the 25 years of history and the tremendous opportunity helping investors access, which, my takeaway is that it feels like it's always a great time to be looking at software, but especially now there's quite an attractive entry point, and there's a couple of ways to do it in equity as well as credit. So thanks so much for your time today.
Thank you very much, and you guys are putting on a fantastic conference. I'm happy to be here.
Thank you. Today, in our Spotlight segment from Connect 2025 in Arizona, I've invited Molly Weiss, Group President of Wealth Platforms at Envestnet, to join me here today to discuss how technology is transforming the user experience for both investors and advisors. Molly is also joining us as a panelist here at the Connect 2025 event to speak about partnership and technology. At Envestnet, Molly manages a broad array of technologies and services, such as portfolio management, financial planning, and performance reporting. She's responsible for creating an overall comprehensive financial ecosystem. Molly, thanks so much for joining us today.
Thanks for having me. I'm excited to be here with you and excited to be at the conference as well.
Thank you. We're so thrilled to have you here. And you really sort of see it all at Envestnet in terms of creating this comprehensive financial ecosystem. And you've been there for about 20 years. So tell us a little bit about Envestnet, what you focus on there, and importantly, how does tech really play a key role?
Tech is definitely at the forefront of how we think about empowering advisors. So we spend a lot of time thinking about how to make advisors more efficient, how to help them provide more and more services and solutions to their clients, and importantly also how we can help advisors do that at scale. So how we can help them really create portfolios and manage client accounts and ultimately serve their clients.
So, solving for scale must be pretty challenging. And, what are some of the problems right now that really need solving? And again, how does tech play a role?
We really believe that advisors want to create custom portfolios or solve client needs with specific portfolios. And so one of the things that we think a lot about in terms of scale is certainly how to help advisors do portfolio management at scale. So we have a proposal system that really is intended to help the advisor go through the process of creating a portfolio all the way through to opening accounts and really using technology to allow for that kind of customization or personalization so that they can scale their practices.
And I'm sure that's the holy grail for everybody.
It is.
And personalization at scale, right, is really a concept as well, and that's everybody's dream. And where are you at with that journey, and how close are advisors to being able to do that?
Using the Envestnet technology system, they can definitely create very custom portfolios, but we're always thinking about ways to increase and enhance that capability. So one of the great things about our partnership between Envestnet and iCapital is thinking about how to incorporate additional types of assets or investments into a client's portfolio. So structured investments is an important component of what we offer to the advisor for flexibility, but obviously we're also talking about alternatives and creating easier access for advisors to create those custom portfolios that also include things like alternative investments.
So I mentioned we're very thankful for the iCapital investment partnership, and from your perspective, what was the origin of the partnership and how is it going, and what is some of the focus of it right now?
What's really exciting to us at Envestnet about the iCapital partnership is the technology. I think that iCapital is thinking about a lot of the same things that Envestnet has and continues to think about. Certainly data, so getting alternatives data or alternative investment data into client performance reports or client holdings reports is something that you're squarely focused on. We're also focused on that as well. So I think that element of our partnership is really important. And then as we think about building out that proposal capability or that ability to do custom portfolios on the Envestnet platform that include alternative investments or structured notes, that's a really important part of the iCapital Envestnet partnership as well.
Yeah, I'm glad you bring it up because we certainly see a great increase in demand for alternative investments and also structured notes, and really this desire of the advisor to be able to incorporate all of that, public markets, private markets, alternatives, SI, into a portfolio. But I'm sure there's a lot of pain points associated with that in the industry. So any way you're solving for that at Envestnet?
It's actually, I think, our partnership that is solving for it, because I think that certainly iCapital has spent a lot of time thinking about how to more seamlessly create an advisor experience that's not swivel chair, that's not having to go to multiple systems to create that portfolio. So I think for us, thinking about how to create a UMA that has an alternative sleeve and use our proposal and portfolio management capabilities, but connected to an iCapital that can really help surface the right documentation and the right level of information that would need to be included as a part of that workflow. I think that's really exciting to us.
So as a technologist, I'm sure another aspect that's really exciting to you is leveraging artificial intelligence, and everybody's focused on it. I'm sure it's a big focus for you as well. So what are some of the best AI opportunities you see right now within Envestnet?
I love this question because I'm excited about AI, and I'm excited about how it will help really empower advisors. There's talk sometimes about how AI might replace advisors, but I actually think it's exactly the opposite. I think AI will help advisors serve their clients better and also spend more time with their clients and know their clients better. So we have tons of data on the Envestnet platform, and that data can be used or can be enabled through AI to help make the advisor more productive, more valuable to the client by surfacing insights. So one of the most important ways that we're using AI kind of out of the gate is to transform data into something actionable and insightful to the advisor about the client, and not the advisor having to go hunt through reports or go search for something, but really surfacing up to the advisor something that they should pay attention to. So that's a really important and I think exciting implementation of AI.
It is hugely important. I always say that AI really has a potential to be the shortcut to productivity, and certainly as an advisor, you're inundated by all kinds of data, from financial market data to client data, et cetera. And so to be able to get the right data at the right time on your desktop is very important. So Molly, again, speaking of technology, you've been into the technology space for 20 years, and I'm sure you've seen a lot in terms of evolution, and also being a woman in technology, it must offer a unique and special perspective. So any thoughts you would share on your experience being a woman in technology, and what might you say in terms of how rewarding this career might be?
I didn't intend to start to end up in technology necessarily. I fell into it a little bit, and I think it was because technology just made sense to me. So as I was kind of understanding some of the business problems in our industry, the technology solutions just made sense in my head. So I gravitated towards technology instead of setting out to be in technology, and probably because it was a little bit intimidating. So there have been so many exciting transformations along the way. I guess I would just really encourage other women out there to think about technology, and also to think about being a leader in technology, because we need more of us.
Right, indeed. And there's little we can do in this day and age and world without technology. So the opportunity set for being in tech is really sizable today, perhaps as sizable as it's ever been. So Molly, thank you so much for your leadership in tech and for your leadership at Envestnet. And we're certainly very thankful for the iCapital investment partnership as well. Thanks so much.
Thank you so much.
And we'd like to hear from you. Send us an email at yourquestion@icapitalnetwork.com and let us know what questions are the top of mind for you and your clients. I'm Anastasia Amoroso, and thank you for joining us today. We'll see you next time on Beyond 6040.